Hi, Beth Riebenstorf with the Reby Homes team with a May market update on both national and local real estate. So my goal with these is to share the data that matters and leave all the conclusions up to you. So let's start with a really important number we've all been waiting for, unemployment numbers. It was a big unknown until updated data was released May 8th. Let's take a look back at the predictions though. JP Morgan Chase, well, they predicted unemployment levels of 20%. Merrill Lynch and Goldman Sachs thought it would end up around 15%, and Wells Fargo thought maybe 7%. Well, the numbers are high as we expected. Current numbers show that April took us to 14.7%, and that's the highest number since the start of recording unemployment numbers in 1948. So 37.6% of the people filing for unemployment, well, they're servers and bartenders. We knew that from a couple weeks ago. Retail workers were another 10% of the claims, and temporary service workers were another 10%. Those three categories together are almost 60% of total claims. Since retail and restaurants have been closed, that's to be expected. And with many offices adjusting, the impact to temporary workers also makes sense. Medical offices and large facilities, they have been significantly impacted with surgeries and all kinds of procedures being deemed optional and put on hold. So as we consider the jobs that are affected due to our economic shutdown, it does make sense. It does not make it any easier for families to navigate, but it is a logical result to the massive business shutdowns. And with the number being 14.7% unemployed, that also means that 85% remain employed. So here's an interesting view of the data. Of the 14.7 unemployed, 13% are adult men, 15.5% are adult women, and almost 32% are teenagers. The point being that once things open back up, what is the expectation for a large portion of these jobs? So let's revisit the projected V or hockey stick shaped recovery. JP Morgan Chase, well, originally they projected that we would see 20% unemployment, and that's the orange V line. Goldman Sachs projected closer to 15%. The future, it's still the future, but 4 weeks of actual data showing a downward trend, well, that's encouraging when we consider the alternative. The biggest threat to all of this in many ways is panic. The way the numbers get used to fuel embers of panic. We don't want pie in the sky, of course, but objective, rational analysis, well, that would be really welcome. Moving on to housing data, we'll start with the local market, the Phoenix metro area. So let's take a look at houses that went under contract. These are weekly numbers, and you'll see that we are recovering from a low April 5th with 1,641. And the next 4 weeks, it goes up to 2,296 ending May 10th. And this is for all price points. If we jump up to the price point of under 300,000, then we see the same trend here, a low week of April 5th of 889. The next 4 weeks it climbs, ending at 1193 for the week of May 10th. And then for the price range of 300,000 to 600,000, similar thing, a low of 658. Next 4 weeks it goes up, ending at 940 units for that week. And then 600,000 to a million, a similar pattern, a low of 68 and jumping up to 139 for the weekly count. The average price per square foot on a weekly basis, that tells an interesting story. This is for all price points. End of March, beginning of April, it was at a high around $299 per square foot, and it's been dropping, and now it's down to an average of $262 a square foot. If we jump to under 300,000 and look at that category alone, we see that the price continues to rise, and that's now sitting at $152.48. In the 300 to 600,000 range, it looks like there's a lot of up and down, but you can see that the numbers are actually pretty tight. It's around the 178, 179, so it's pretty stable there. And the last category that we're sharing here, 600,000 to a million, that was a high of 235, and it's down to 228. And finally, a quick look at some of the national data that is now out. The big story is housing supply. it remains at historically low levels. So in July of 2019 compared to July of 2018, there was 1% less availability. January of 2020, there were 11% fewer homes available than January of 2019, and it continued through February and March with 9% and 10% fewer homes. And this chart really puts it into perspective when you look at the change in availability from 2011 to where we are today. Overall, the U.S. was up 0.8% from the previous year, while the Northeast was down 3%, the Midwest was up 4.2%, and the South was up 0.9% and the West was down 0.9%. So two last pieces of data to look at, and that is buyer activity or foot traffic. How many buyers are actually looking? And as you might imagine, it is well up. Inventory is low, but buyer demand is very high. The low inventory coupled with high demand, well, that leads to some price increases. And we can see here that overall the U.S. had a year-over-year increase of 8%, the Northeast 8.3%, the Midwest 9.7%, the South was at 7.5%, and the West was at 8%. So the story on a national level is housing supplies are at a historically low level and are anticipated to be for some time. Again, my goal is to provide facts, not fear. Yes, there is bad news, no question. But there's also good news. There is both. So as the future unfolds, we'll continue to bring you objective and accurate data so you can draw your own conclusions. Until next time, stay safe and stay healthy.